it doesn't just have to be Tim, but are you guys finding that student loan debt is affecting the purchasing power of first-time home buyers?
That rule changes every couple months, doesn't it? It seems like the guidelines are constantly changing, and they went so far with the pendulum at one point. It was almost impossible for anybody with a student loan. They have swung back a little bit the other way, and depending on just the loan program, it depends on how they're going to look at that student loan debt payment. Okay, but typically, whether it's deferred or it's an income-based, they're going to come up with some type of payment to add to that debt ratio. And that's how we're dealing with it today.
There's actually a new rule came out, just kind of to accent it. Fannie Mae came out recently, and Fannie Mae now allows for income-based repayment, which is awesome. So whatever's being reported on the credit report, and I have a good example. I've got chiropractors, and they had over $200,000 in student loan debt, and you know, for an FHA loan, I would be dead, basically, in a nutshell. But on a conventional loan, they allowed me to accept the actual payment on the credit report, which was $100. Okay, so it's amazing the differential. So think about VA. Remember, VA was probably by far the best. Allows you to defer for a year or forbear for a year. We don't count the payment against you at all, right? Where conventional loans, under the new Fannie Mae rule, allows you now to accept the payment that's on there. And then, to me, I'd blanket it with like a VHDA product, if you will, depending on what you're looking at. You can actually have some advantages. But it does put a little inkling on your USDA and on your FHA product from the ratio standpoint.
Also, if somebody else is paying that student loan for you, like your parents, then we wouldn't have to include that, as long as we can show 12 months of payments by somebody else.
The amount of it is definitely increasing, so it's more of a factor now than it's ever been.
I got another question. So there's a law passed or something that changed with the credit bureaus where they were going to start accepting utility payments, phone payments, bills, whatever it is. However, my understanding is that these, Verizon's not like going to the effort and paying the money to actually report that to the credit bureaus to help credit scores. Is there any potential for those? I mean, because they open up the door to like have other avenues to build credit as opposed to just.
Well, Verizon did a few years ago, and it was a disaster. They had more errors on it than they did accuracy. So, in trying to help, they didn't. But yeah, that's just going to evolve with time.
Experian actually announced that they're going to allow it in the fall. And what they're going to do is they're going to allow it, however, semicolon, however, comma, there's going to be a fee involved. So you want to add your rent, you want to add your utilities, you want to add insurance, you can. In my opinion, hey, if it impacts the score and allows you to, leverage yourself in a little better position, home run.
So each borrower
would have to apply or position it. And they're coming out with more of a definition of what they're doing. But I know Experian said the fall. I have not heard about Equifax or TransUnion.
I think you're going to have a tough time, utilities companies doing that, because it's very expensive.
That's what I'm saying. It's like
very expensive for them to report that.
Right, they might be able to do it, but there's no.
It's a borrower pay fee.
Right. Yeah. So there's no motive for them to do that. So
I do see more and more rent. If you have a client who pays their rent through a rental management company, I am seeing more and more of those on credit reports.
Okay.
I see a lot of those when they don't make their payments too. I hate when that happens.
I've heard one or two of you say something about this, but a question kind of for all of you: is there a blanket for the industry on how soon you can buy after foreclosure or bankruptcy, or is that different with the lenders on the program? Like,
it's going to be very much program specific. I mean, your conventional Fannies and Freddies, they're the most strict on that. But you're seeing more, the fastest growing segment in mortgage lending is non-QM, or non-qualified mortgage. And it's the simplest way to think of that is the good parts of subprime lending back in the day. Subprime was abused for sure, but some people don't quite fit in the square box that we need them to fit into. They're very good borrowers or very good risk, but so non-QM or non-qualified mortgage, they've been allowed, pretty much throughout the entirety since we've recovered from the housing crisis, but there's just different regulatory requirements on them and burdens on the lenders, and so a lot of lenders just stayed away from them. But as things have eased and portfolio quality has improved. We're starting to see more and more of that. And so in your non-QM sectors, that's where you're going to see things that these loans that are outside the box that lenders are comfortable taking. So there's no blanket. General rule of thumb is 7 years on some of that stuff, but there's a lot of options below that. VA, for instance, they don't have any rule whatsoever on short sales, but they do on foreclosures. FHA's 3 years kind of across the board. It's just it varies product to product.
And I think all the lenders, the wait period, the derogatory wait period, I think was created to allow the borrower a chance to recover, so to speak, and repair that credit profile. That's really what they're looking at. Underwriters look at very specifically. If they had a bankruptcy, you better have a clean history after you got that second chance, all right? No lates after the bankruptcy. It's really going to hurt you if you haven't, recovered and got your act together, so to speak. These lenders that are doing the out of the box, anywhere from 1 day out of bankruptcy to a year or so, you're putting down large down payments. That's where they're protecting their risk. Those loans are not sold on the secondary market like Fannie and Freddie's. They have to keep them in their portfolio, okay? And so the risk is all that lenders. And so they're protecting that risk by usually requiring significant down payments. There's higher interest rates. Sometimes there's prepayment penalties. So we look at it as a Band-Aid, okay? Get you in the house, and then we'll look at in a year or two, hopefully getting you into a normal program.
If I can add, everything is circumstances beyond your control. So keep that in mind as well. Like FHA actually says you can do 1 day after a short sale, provided your payments were on time. But how many short sales are going to happen if they didn't make their payments, right? Think about it, right? But there are circumstances beyond your control. There are situations where VA says, you know what, 1 year, you get out after a foreclosure. If the situation, they close the base, for example. FHA, I had a guy where the little truck that he was driving fell over and he got crushed. Okay, you can do 1 year after a bankruptcy, after a foreclosure. At VA, every FHA, USDA all had that flexibility. But Scott's right, conventional financing, Fannie, a little tighter along the ratios, but every situation warrants consideration, right?
There are extenuating circumstance provisions, even in the conventional loans.
Is there a restriction on gift funds now that can only be a relative or?
You talk IRS, or are you talking about individuals?
Individuals.
To be quite frank with you, there is no limit from the perspective other than they may be liable for some kind of tax situations, but there's actually ways to work around that too, as long as you declare it to the IRS. But I don't remember what the gift limit is. I think, Scott, is it 18,000 for individual?
Oh, it was 15.
Yeah, it went up recently. Let's say it's 15,000. So let's say you have a husband and wife buying a house, right? And you have mom and dad, and then they have a mom and dad, right? What's kind of cool is mom can give the daughter 15, dad can give the daughter 15, mother-in-law can give the daughter, and you could get 60,000, not even have that kind of a challenge. Now I don't actually have a parent willing to give me that kind of money, but I'm always willing to be adopted. So that's an opportunity if anybody needs, a son.
Suppose the parent gives, dealing with one daughter, but suppose the parent gives, because it's a single parent, gives the second daughter the money, and the second daughter gives the money to the first daughter.
As long as you can paper trail it, it's highly acceptable. It's paper trailing is all it comes down to. We need to see that to make sure that there's not additional debt being incurred by the borrower. We want to make sure that the borrower is going to be okay. Is there a limit? No. I've had clients buy $500,000 houses and put $300,000 down. And it's all a gift from granddad. It's very possible.
I thought there were IRS restrictions that created a problem.
So IRS restrictions, the only thing that they're and of course I'm not an accountant, don't pretend to be one, right? Okay, I want to make sure I put that little caveat in there. But realistically, no. What it comes down to is, I believe the rule is that if you do plan to give a larger gift, it comes out of the total gift exclusion that you have, which I think is $1 million. So that means that if you gave $300,000 in my example, you'd have to declare to the IRS. Now you can no longer give that $1 million umbrella, if you will. Yeah, and there's also timing too. Like sometimes my clients will give the $18,000 December 31st, and then the $18,000 January 1st. Just depends on how you apply it.
I just had a quick question on the clarity of. So on the real estate, our realtor side, we have form changes, law changes, January 1st, July 1st, usually where we can kind of anticipate changes. With FHA, with VA, with USDA. I mean, is there any timeline that you're looking for, or is it constantly rolling?
9 o'clock, 12 o'clock, and 4 o'clock.
We get notification.
Yeah, there are some annual changes. VA has an annual meeting in April every year, and some things will typically roll out of that.
I think it's 30 something, and then a month it's got to change.
Yeah, so there's policy changes from the insurers themselves, either the government agency or Fannie, Freddie, that kind of thing. And then there's investor overlays that change repeatedly, because just because FHA says they'll take something, not all investors want that particular product. So there are some things like that, but it's not, okay, we get our changes in December and we're good to go for 2020. It's a constant. I've got a saying, for years I've said in our industry, if you're an expert on Friday, you're an idiot on Monday. So we got to stay on top. Our quick reference manuals are an inch thick, so that tells you a little something.
You all haven't said anything about 203Ks.
Sorry?
You haven't said anything about 203Ks.
I do 203Ks and I do home styles. I mean, 203K is a primary mortgage for an FHA purchase, right? So we've got to stay within that umbrella. Of course, you do multiple units under that umbrella. But home style, which is the conventional Fannie Mae, Freddie Mac rehab product, actually offers a rehab product 5% down for primary, 10% down for second homes, and then 15% down for investment. So there are some pretty wild products. And the nice thing is, if you do the investment, they allow you to count the proposed rent payment to offset the mortgage payment. It's kind of wicked, to be honest with you. There are so many pennies, it's unreal.
75% of that proposed rent?
Yeah, exactly. Yes.
There are more and more renovation loans coming out as well. Freddie is has their own renovation loan now as well. And in May, they're coming out with what's called Green Choice. It's going to be similar to the mortgage energy.
So EEM, energy efficiency mortgage, right? And you can complement that with like a solar mortgage. There's multiple.
That's rolling out in May. And we also do a VA renovation loan for veterans.
Each one of those has a little tweak on the interest rate, right?
Yeah.
Do any of you all do the renovation mortgage out there? I can't remember who told me about it, where it doesn't have the same limitations as I know I did one through CNF last year.
Right.
Where the contractor had to be in charge and write up all the quotes.
So there are actually two levels of rehab products. Yeah, you actually want to look at a streamline FHA under 35,000 or a streamline home style under 50 is really the way to go if you can, because then you don't get the consultant involved, right?
Right.
So and then the other catch-22, which I love, is the ability to really upfront 50% of the repair escrow, right, for materials. So by far, if you have the ability to keep your balances down below those magic numbers, it's huge. If you want to do self-build, to be honest with you, and I deal a lot with Colonial Farm Credit, they have probably one of the best self-build, self-managed products out there, but it's 20% down. It's a big piece of pie. And most folks don't have that kind of pie. I preferably, and I don't know about Deneen, and I know Scott's our expert here, but I would much rather have at least some kind of construction manager involved, because quite frankly, there are pitfalls, and Scott can tell you about this, that will just blow your mind. But you can use a construction firm, by the way, product to do renovation on top of that. And I know we didn't talk about that, but that's an option as well.
We typically try to stick just to the streamlined products for the 203Ks, and if they need more than that, a construction loan is probably going to be a better fit in those cases. It's not that we won't do the other ones, but we do them rarely.
Your biggest challenge is the contractors on those 203Ks, finding somebody that's reliable. They're going to get checked out. A lot of them don't want to fork over their financials, and that's just protecting you and the lender. And their paperwork's not always very good, and so it is a challenge to try to take that on yourself.
Yes, I had a question. Someone asked me how long the bankruptcy stays on, and I always remembered it to be 10 years. Is that correct?
So the bankruptcy reference itself is 10 years, but the reference to all the debts is 7. So derogatory debts are 7, but public records is 10. So they're just going to reference it on the credit report, but beyond that, it really is going to have minor impact.
And I have another question, and I guess it would be to you. If someone wanted to do a construction loan on a house that's all, they're adding something on, and they wanted to put in solar, is that something that would fall under?
Typically, we're looking at a percentage base on that. So we'd like to see, before we do a construction loan, at least 25% of the value of the project in new money. So
Okay.
if they've got a $300,000 house and they need, $30,000 for solar, we'd probably go towards 203K or home
Yeah,
sale.
K has a solar addendum. In fact, the FHA has a solar mortgage, which allows you to go, 20% above the county limit, which is kind of wild. And you can use it not only for solar, but geothermal, which has really become very popular as well.
So it's going to depend on the project.
Also wind, but I'm not sure we have a lot of windmills around here, right?
Right.
Well, not yet anyway.
Well, give it time, you never know. The efficiency might be there.
Today's a good.
Oh, amen.
Do we have a question? I think we have a question. You have a question?
I was just wondering, so say you have somebody who is in the USDA and they want to search for a house, what zip code is the best for that? Because that's rural, right?
Now, as you go to USDA RD property eligibility, you plug that in. If you put in USDA RD property eligibility, you actually bring you to the USDA site, and you pop in the address, and they'll actually pull you up. Think about it this way, like Fredericksburg's not USDA, right? But really the surrounding areas are, when you think about it from that perspective. I like to think of USDA as the country loan, right? And then VHDA, FHA, that marriage there is more of the city loan complement between the two.
I don't know if it still is, but like Colonial Forge off of Courthouse Road was already one of the.
You only have to get a couple miles off the 95.
It's wild as bones, oh yeah. It's like one side of the street is FHA and the other side's RD. There you go.
And those maps do change. So,
Just bookmark it, number.
oh, no.
Ah, okay. So I don't know if my question is for this panel, but I will try. I have a client who's looking for a home in Stafford for up to $500,000, and they actually asked me a couple times, what if we buy a home, we get that loan, and then the economy goes down and home prices go down and we'll be stuck with that $500,000 loan. What do I tell them?
They have a beautiful home, right?
Right now, while the economy's slowing, recession is not guaranteed yet. And even if we go into recession, it's probably a better term this time would be more of a correction.
Right.
A healthy correction. Economies have to do that once in a while. We are nowhere near the circumstances that we had in the bubble prior to they called it a recession, they just manipulated numbers. We had a depression 10 years ago.
Yeah.
So, will home values go up and down? Sure, but right now, we're not anywhere near that. We're just, instead of 6% growth or 4% growth. So, if it takes 2 or 3 years to get to recession, they're probably going to be 10 or 12% more before they even start to see any retraction. So we've got some cost of waiting analyses and things we can do for them to kind of see what waiting looks like.
Right.
And it's a legitimate fear, probably because most people don't understand economics. It's not a day job for too many people, but it's not a well-founded fear right now.
Honestly, we don't buy houses anymore like we did 10, 12 years ago. I like to think of it as like cowboy real estate, right? I mean, think about it. We put a sign out there and we whip them in, and all of a sudden they were doing loans and they were buying houses, right? They were doing ninja loans, no income, no asset, right? No pulse. It was kind of weird times, right? Nowadays, I think the consumer is more focused on, is this house going to satisfy my long-term needs? Is it in the right housing? Is it in the right community? Can I afford the payment? And that's why, frankly, I prefer a 30-year fixed rate, because you really don't see the adjustments that occur, other than you might be able to drop the PMI off, which would be phenomenal. Or on the other side of the coin, maybe you'll see some correction along the lines of the taxes or the insurance. But otherwise, I tell people, look, my folks bought their house in 1961 for $12,000, which at that point was a lot of money. In 61, I was 1 month old. That's why I know. I remember, right? My point of the matter is today their house is worth over $1 million. They paid the mortgage off. They stayed in the house, kept living in it. And my philosophy is, listen, if they move from there, they're going to rent. And how much of the rent goes to principal? Nothing. You know what nothing times nothing is? Nothing. So my point is, pull your pants up, tie your shoes on, get to work, keep making the payments, because in 30 years, you got an amazing asset that's paid in full. It's like that one guarantee that people don't realize. That's where we have to kind of turn things around. In my opinion, we need to focus on the true American dream, which is financial stability, long-term growth, and you ready? Respect and focus on what we believe in. Too many people have that short-term vision. I can't make it, I'm going to give it up. My philosophy is, no, we're not built that way, right? So anyway, that's my philosophy. Running for President of the United States 2024, thank you.
So, speaking of homes that you live in your whole life, you pay them off, all that stuff, when it comes to the point where you need to renovate it,
Right.
Are there any financial products that you can use to renovate a house that's paid off?
You know what I would do, I don't know if you guys, I just get a bloody home equity line. Home equity lines, and I prefer the credit unions personally, because credit unions are nonprofits. Okay, and typically they have the best terms. The house is paid in full. It's just 1972. It's still got the avocado range. You know what I mean? The fridge, the whole 9 yards. I get a home equity loan, do my own self-repair, and move on. It's the most flexible. It's the easiest. It's self-managed. Interest only on what you borrow. It's a home run. That would be the easiest, in my opinion. And then when you're done and you plan to keep the house long term, then I would approach one of us and just refinance it to a fixed 30-year or 15 or 10, depending upon their long-term focus.
I'm beginning to see people change for just stay in their home, to live in their home.
Yeah, first time I
to change the doorways and get that where that you can roll in.
Think about it. First time home buyers used to be 3 to 5 years, right?
Yeah.
Okay, then it went to 5 to 7. I think it's veering to 7 to 10. Yeah, Clay. I think you're right on the money.
But the inventory is not going to be as good because people are not getting out of their homes now. They're deciding to stay in there.
That's why we need you guys to buy investment properties. Let's flip them up. Let's make it happen. Come on, get out there. You guys are the professionals, right?
To that point on the rehab side of things, I feel like I've talked to so many first-time home buyers who have been spending their past 6 months watching HGTV and
Sure.
know what they're going to do. They're going to move this wall. There's a perfect storm of these 2 or 3K loans I feel like out there, but nobody ever chooses to go with them.
I'll tell you the product I would choose. This is me. USDA RD allows you to finance repairs up to 10% of the sale price, provided the house appraises, right? So let's turn that wagon around. So so let's say, for example, and I've done this before, we buy a house for $150, but it needs new roof, new doors, new windows, it needs appliances, okay? As long as we identify those required repairs, you can incorporate them in the sale price of the house, or the house appraises for 20 more, you can bump it up, remember, up to 10%. The catch-22 is you got to do the repairs within so many days after closing, because we have to deliver the loan to the servicer. And so my philosophy is, yes, I agree they've watched too much TV. We watch too much YouTube. It's just insane.
But there's a willingness on their part to do it.
There's a way to do it.
And it's also like you've got the homes that are out there. It's like, okay, these are super dated. Like that's all that's available to them.
But it's dated.
Yeah, but many of those are not hearing homeowner. In other words, the HGTV people want to kind of do it themselves, right? Right?
Yeah,
with their sweat equity, and a lot of these, though, you've got to have the contractors. They're
Well,
not letting them do the work themselves.
This is true. I will tell you, there are some credit unions out there that actually will do 100% home equity lines within 60 days close. Yeah, so I've had clients buy the house with honesty that had equity built into it, and they've gone in and gotten the home equity loan up to the 100% value of the property, provided they meet the terms and conditions that apply, right? And they've sucked out the marrow that way to doing the improvements they want to do. Otherwise, if they want to do a 2 or 3K, they're going to have to pony up.
We do a handful every year as construction loans, though, because if they're doing major renovations, they're going to get a contractor anyway.
Yeah.
So
I just wonder why it's not that. I feel like our area is prone. It could benefit from it. And I always talk about
a lot of our inventory is.
A lot of the flippers.
Yep.
A lot of flippers come in and grab them.
It's picked over, so We're seeing it more and more.
I would bring a bunch of investors in and, quite frankly, identify them as flip potentials and bridge the gap. In my opinion, you've got buyers that want to buy at 250. If you got product that's low enough and that you can squeeze enough margin out of, why not create an investment pool, bring your investors in, teach them a little bit about how to flip homes, maybe pull in a little info on private money. I don't know if Deane's got, rehab money, but you can get flip money and then fix the house and flip it, and then you get all the sides, which would be kind of cool too.
All right, so we are running out of time. We have like a minute left. So first, I'd like to say thank you to the three of you for everything. Thank you all for coming with your beautiful questions. But just to give you guys like 20 seconds piece, there's something you didn't talk about that you would like to say.
Ladies first.
No, thanks. I want to share quickly one thing I didn't talk about. We have a one-time close, a construction loan. It's available through FHA, VA, and USDA. It allows the 100% financing, on VA and USDA, it's 100% financing of the land improvements, and the home. It's available for stick-built, modular, and manufactured homes. And so it's a nice product for somebody who's out there looking for land and doesn't want to be in a cookie-cutter subdivision. So.
Scott?
I'd just like to mention one program that's pretty exciting. We just rolled out last year. We've got an investment property program we can qualify into debt service coverage. So it's the closest thing to a no income, no asset loan that you get. Yeah. It's not the no income, no asset things of the past, but so the quality or the property has to be able to rent if it is already rented, or we get a rental analysis, so it doesn't even have to have a renter in it. But those can go up to $5 million. They can be to LLCs, doesn't have to be an individual. So they're really geared towards those investors who know what they're doing and just having trouble getting some of the conventional financing. So it's a pretty slick program.
Multi-unit.
Mm-hmm. Up to four.
Yeah. I mean, honestly, CNF, the difference in my opinion is we're known as connectors. We try to connect you to the right program and to the right place. Sometimes, quite honestly, sometimes we have the product, sometimes we don't. And so our philosophy is we're going to connect you to the right source, because ultimately at the end of the day, we want you as partners, we want you to succeed.